Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, September 15th, and I'm recording this from my vacation in Sag Harbor, New York. Despite the usual hand-wringing over September being the weakest month for stocks, the equity bull has not slowed down at all. The S&P 500 is actually up 12% year-to-date and continues to make new all-time highs. We, in fact, see decent odds that the benchmark index will reach Morgan Stanley & Co.'s 7,200 bull case target price by next June. However, equity markets are currently priced for perfection, with little room for disappointment. While the Fed's pursuit of maximum employment and price stability is critical, we're also watching three developments that could affect the current bull case. First is the usage and adoption rates for generative AI, which appear to be plateauing. This raises uncertainty over the rate of AI CapEx growth. Consider that a U.S. Census Bureau survey of 1.2 million companies showed usage and adoption actually peaking at the largest companies in the month of June at around 14% and has already been falling to 11% by August. Meanwhile, research from MIT Media Lab and Project Nanda found that 95% of all AI pilots at companies have produced no measurable return or improvement in productivity yet. Our point here is not that AI's long-term potential is in doubt, but rather that data center capacity may outpace the immediate return on investment, leading to a slowdown in AI CapEx spending. A second area of skepticism is corporate margin expansion. Forecasts are calling for 140 basis points of expansion next year, but based on recent PPI and CPI reports, prices for producers have been rising faster than those for consumers, suggesting that profit margins are in fact being hit at tariff-exposed manufacturers. We see this headwind, in fact, increasing in 2026 as the effective tariff rate approaches 18% and is fully absorbed and realized. Finally, it isn't clear that Fed rate cuts can actually boost the softening labor market. Recent downward revisions to U.S. employment data indicate that the Fed's 100 basis points in rate cuts last year did virtually nothing to spur hiring. In fact, several longer-term issues in the labor market are starting to emerge. For example, job creation is running at only about two-thirds of the rate needed to stabilize the unemployment rate, and demand for workers is shrinking as employers try to increase margins. While demand is stalling, total labor supply is also growing glacially, with baby boomers retiring and immigration reform removing around 1.5 million potential workers. Looking at all of this together, we need to consider the idea that the U.S. faces a structural conundrum in the labor market that pure Fed rate cuts may not solve. The equity markets have tended to view any bad news on the economy as good news, in that it could accelerate Fed rate cuts, and this has supported positive correlations between stocks and bonds. But at a certain point, bad economic news will be just that, bad. The implication is that stocks and bonds may remain positively correlated and move together as they did in the 2022 bear market. In this environment, consider selling small caps, unprofitable tech companies, and low-quality meme stocks, while being highly selective in consumer-oriented names. We're adding real assets, including gold and REITs, to portfolio that are benchmark-weighted in passive U.S. equities. In addition, we're actively selecting U.S. large-cap quality stocks. We suggest intermediate duration investment-grade fixed income as well, including municipals, international equities, emerging markets, hedge funds, and private secondaries. In private credit, we favor asset-backed lending and distressed investments. As always, thank you for listening. And for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.